Hello, I'm Charles Boettcher, Managing Director and Senior Portfolio Manager at City National Rochdale. Welcome to Market Perspectives. Let's review the first half report card and then take a look forward. The first half 2024 was good for most equity investors. Most major stock indices were positive. The standouts included the S&P 500, up a little more than 15%. The MSCI All Country World Index was up 11%, and the NASDAQ led the way, posting an 18.5% return. Bringing up the rear were small cap stocks. The Russell 2000 was up, but just 1.6%, and the S&P 600, another small cap index, was down 74 basis points. The U.S. continued to outperform international. The MSCI EAFE and emerging market indices were both up, 5.3% and 7.5% respectively, both lagging the S&P 500. Most fixed income asset classes have erased early year losses and gained positive ground in recent months. Overall, first half results were mixed. The Bloomberg U.S. Aggregate Index was down 71 basis points, and the Municipal Bond Blend Index was off 63 basis points. High yield indices fared better. So, a rewarding first half. What can we expect for the second half? July is off to a good start. However, it is prudent to expect equity returns to moderate from the current pace. Let's look at valuation and breadth, two things that we're paying attention to. Followers of City National Rochdale speedometers may have noted that the S&P 500 valuation speedometer has moved into the red. While it signals a caution, it is not a cause to sound the alarm or to adjust allocation at this point. Remember, valuation and equity outlook are separate things. You will recall that corporate earnings have been exceeding expectations, which eases the valuation pressures. As seen here, City National Rochdale's earnings growth expectations are lower than consensus, but still healthy, continuing into 2025. If earnings forecasts prove correct, the weight of higher valuations eases. Note, second quarter earnings season is kicking off. We believe that broad valuations don't tell the full story, and many companies are trading at lower valuations. Valuation is not a good predictor of short-term returns. It's more broadly correlated with long-term returns. It's one component. Current trends and momentum matter as well. As you can see on this chart, dissecting valuations provides different perspectives to the overall headline number. I want to address questions and comments that have arisen from those who have heard us state that the market rally is broader this year than last year's narrow Magnificent Seven-led rally. Allow me to clarify. Yes, breadth is better. However, yes, the rally is still lopsided. Communication services and tech are still leading the way, but all of the other sectors are positive year to date. Sans one. Real estate is the lone sector viewing the party from the outside. So, better, yes, but we'd still like to see more breadth. To sum up, keep an eye on earnings. The consensus second quarter S&P 500 year-over-year earnings estimate remains over 8%, which is the highest growth rate since the first quarter of 2022. Hopes for the rally to broaden will be tested by reported profit growth in the sectors outside of the tech-related leaders. I'm Charles Boettcher with Market Perspectives. Take care.